Whenever you put money, such as your pension, into investments that are related to stocks and shares, risk is part of the picture. It's a fact of life that risk and reward go hand in hand, and when you're taking an income from your pension in the form of income drawdown, risk can have a significant effect on the success or otherwise of your pension to provide you with a sustainable income in retirement. First, a quick reminder of what income drawdown actually is. Broadly speaking, you have two main options at retirement. Either you can buy a guaranteed income for life provided by an annuity, or you can invest your pension savings into an income drawdown plan. With this option, your pension fund remains invested and you draw an income from it each month or each year. And because your pension savings remain invested, the risks associated with your investments remain an important factor to consider. When you take a regular income from your drawdown pension, the impact of those withdrawals differs depending on whether stock markets are rising or falling. When they are rising, as the investments are worth more, you have to sell fewer units or shares to realize the amount of money you need. But when they're falling, you're selling more units or shares to realize the money you need for your income. If there's a bad run of stock market falls, particularly early on in your retirement, then your fund may be severely affected. And this may mean that the level of income you can draw may have to be reduced, or worst case scenario, your pension funds could run out altogether one day. Now, as markets will be up sometimes and down on other occasions, then you might think that things can average out over time. This is sometimes called reverse pound cost averaging, but you should always be careful of averages because they can be very misleading. If the value of your pension halves in the first few years of retirement, then averages won't help you. Much of what I've described here is known as investment volatility, and there's another way that investment volatility can impact your pension fund savings. It's called volatility drag, and it works like this. Let's say you have a £100,000 pension pot. In the first month, it drops by 15%, and in the second month, it grows back by 15%. How much have you got? Well, your average return over those 2 months is zero, but that doesn't mean you still have £100,000. At the end of the first month, you'll have £85,000, so that 15% growth on that figure only gets you back to £97,750. To get back to £100,000 from £85,000 needs growth of over 17%, not 15%, which means that your investment has to work that bit harder to catch up. Markets and investments in markets are constantly fluctuating, and this movement will impact your pension savings performance over time. Finally, when you delay purchasing an annuity or decide not to do so at all, your pension fund bears a cost, sometimes called mortality drag. This sounds technical, but in essence it's a fairly straightforward concept. When you buy an annuity, there's always an element of cross-subsidy in the amount of income you are offered by the annuity company for your pension savings, as it is based on a pooled risk approach. Cross-subsidy is where some annuity customers who die earlier than expected subsidize those people who live longer than the annuity company expects. This cross-subsidy is a natural part of many insurances, including annuities, and it can either work in your favour or not, depending on how long you live. If you choose instead to put your savings into income drawdown, you won't benefit from any cross-subsidy, and your drawdown fund will need to work increasingly harder as you get older to replicate the value of the cross-subsidy you are missing out on. If you decide to opt for income drawdown instead of buying an annuity, it's important that you understand how these different risks might affect your fund over time. That way, you'll have made an informed decision about whichever route you choose. Thanks for watching.